Good morning and welcome to the Killik & Co market update. We're now 6 weeks into the new year, so we thought we'd take a look at market performance year to date. It's been a good start, but as always, there have been some differences in performance between the different market indices. On here, we're comparing the returns of the FTSE 100 in the green, the MSCI World in the pink, and the S&P 500 in the black. Over this time period, the FTSE 100 is in the lead and the S&P 500 is in third place, which is the opposite of the trend we've seen over the last decade. To give us a bit more colour, we can look at how different sectors of the market have performed over the last 6 weeks. Here we have an S&P 500 sector heat map. The dark green boxes show companies and sectors that have performed the best, and the dark red boxes show companies and sectors that have performed the worst. If you look at the right-hand side, you will see there has been some weakness in the technology sector. Apple, Nvidia and Microsoft shares are all in negative territory over this time period, and this has held back the S&P 500 index as these are the biggest companies in it. Apple is down over 5%. The company is still very exposed to China and will be negatively impacted by Trump's latest set of tariffs. The FTSE 100 doesn't really have any technology exposure, but it does have a lot of financials and materials, and these two sectors have been in favour this year so far. You can see this by looking at the boxes in the bottom left. So this is a good reminder of the benefits of having a diversified portfolio. Trump has been speaking with Putin this week regarding an end to the war in Ukraine. Ukraine apparently has not been involved in the talks so far, and European leaders have criticised Trump for giving Putin everything he wants. However, markets have been moving this week as though a peace deal might be on the cards. First up, we've seen a drop in the oil price. The war in Ukraine has led to sanctions on Russian oil, which has disrupted the oil market and put upward pressure on prices. Here's the 5-year chart showing a big spike in 2022 following the invasion. Prices have declined since then, largely due to a drop in demand from China, but there has been a further drop this week due to the possibility of an easing in the supply chain. We've also seen a rise in European construction and infrastructure stocks this week. It's likely that Europe would be involved in the rebuilding of Ukraine, which could benefit some of these companies. A new ETF was launched last year which focuses specifically on European construction and infrastructure stocks. This is the year-to-date chart in percentage terms, showing a noticeable rise this week. And lastly, this week we've seen a record high for shares in EssilorLuxottica, which is the global leader in the design and manufacture of lenses and glasses. The company was formed back in 2018 from the merger of Essilor, which was the global leader in lenses, and Luxottica, which was the global leader in frames. For example, it owns brands like Ray-Ban and Oakley. Some people were surprised that the merger was allowed to go through because the combined company now accounts for such a big proportion of the global eyewear market. Here's the 5-year chart. The shares are now not far off €300. The recent partnership with Meta to produce the Ray-Ban Meta smart glasses has piqued the interest of more investors. Looking to the future, the global need for glasses is certainly growing. The increased use of screens has resulted in more short-sightedness, and it's thought that by 2050, just under 50% of the global population will need glasses. Moving on to have a look at next week, it's a big one for the mining sector, and we're expecting results from BHP, Rio Tinto and Newmont. So that's it from us. Have a great Valentine's Day, have a great weekend, and we look forward to seeing you next Friday.